Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 24th, 2023. I'm Justin Klein, host of InvestTalk and CEO of KP Financial. And thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, "The End of the Tightening Cycle Brings Support to Stocks." And I want to touch quickly on the market expectations for Fed tightening going forward, and it's pretty clear that the pivot is here. Now, if we head over to July, right, this is a 6.6% chance that they will be where they are right now. They raised rates 25 basis points this week. Their expectation right now is for them to be there, 6.6% chance they're going to be there in July. That's 3 months from now. Roughly 4 months from now. It's not that long. And there's a 54% chance there'll be one cut by then, 34% chance there'll be two, and 5.3% chance it'll be cut, right? The next three meetings. So that's pretty interesting. You know, that's a massive shift in expectations for Fed tightening from where we were just a week ago. So I wanted to highlight that. And then the bond market, right? The bond market is becoming a bit illiquid, and you see that with German bonds. You see U.S. interest rate futures. Jeffrey Gundlach, the CEO of Double Line Capital, runs billions and billions of dollars of capital, and talking about how wildly illiquid the Treasury market is. And remember, the Treasury market prices off. It's the base price for a lot of different types of securities, like mortgages. And so, you know, the lack of liquidity in here just means there's not enough dollars within the system to sop up all of those debt issuance. You know, we have a lot of debt on our balance sheet, and that's what you're kind of seeing as of late. And that's why you have the Fed and global central banks boosting dollar liquidity with swap lines. They're trying to get more dollars out into the system and create more liquidity. You obviously have issues in the CMBS, the agency-backed CMBS, so Fannie and Freddie-backed bonds. Typically, they trade at a tight spread to the Treasury rates, but right now they widened out 20 basis points. Doesn't sound like a lot, but in this market it is. That's to 27% and the highest level since October. So that's something to watch as well. And then short sellers are really attacking these office REITs and the office debt. And you can see companies like Vornado. Let's see if this, let's pull up. There we go. Yeah, Vornado, look at this, just plunging to new lows. And a lot of these commercial-backed REITs, commercial-backed bonds, just not doing very well. And that is dysfunction in the credit markets. And PE Pal, private equity pal, he wants credit to flow. And so that's why you see this pretty strong pivot. Now, existing home sales month over month, that was up, but that's lagging. That's February, but those were signed in late December, January, and they closed in February. So, and that's when mortgage rates were 6% as opposed to 7%, which they were just a few weeks ago. New single family homes, that was up. Let's see, third month in a row, fourth out of 5 months, and just shows you how strong the new single family home market is, because there's not a lot of existing homes on the market, and so that's why those new home builders are doing so well. Durable goods orders down for the second month in a row, something to consider. But overall, the economic data was pretty light this week. Now I want to move over to the charts and talk about the MOVE index, MOVE. And what you can see here is this: when this gets above 150, this becomes dysfunctional, and it just shows the dysfunction, right? So instead of hearing about it, you can just kind of follow the MOVE index. Do we stay below 150, or are we higher? And I think as long as we're above that 150 level, the Fed's going to continue to pivot, and you're likely to see the dollar continue to weaken. Strong today, but overall on the week, definitely down despite the Fed hiking, right? So just shows you how dovish this hike really was. The NYSE, that one was up 65 points today. But what you can see here is it tried to break down earlier today, and it reversed the entire day and closed near the highs. Definitely, at least near term, somewhat bullish. The short-term junk bond market that attempted to break down and also reverse close the high of the day. Do we get a follow-through on Monday? Something I'm definitely watching as well. Let's look at growth versus value. Yeah, that was a nice reversal as well. So, will we get value reasserting itself to the upside, right? Those cyclical names. That's why growth has outperformed recently, because those cyclical names, the banks, for example, which another reversal today, those have been taking it on the chin, along with energy, right? But those are all looks like they found nice support this week, or really today. This candle on high volume, look at this kind of above average volume today, closing near the highs. Here's the industrials and many parts. Let's go to the transports. Many parts of the cyclical part of the markets are doing well, are recovered nicely today. So we'll see if we get some follow through next week. The VIX, that one closed down today despite the volatility. You can see this isn't really breaking out. You expect it to, but this is just right now, so far, a lower high, right? So a Fed pivot looks to be here. And I've said this, they have PTSD. They don't want a deflationary spiral and a banking crisis again. They're going to do what they can to bring liquidity back into the system, and they're going to be on top of it. The generals always fight the last war. And the last war still is 2008, and they're going to continue to pound on that and try to stimulate the credit creation and err on the side of more inflation versus a deflationary spiral. And that's why we said this decade is likely to be marked with elevated inflation overall. Now, is it going to be runaway inflation? Probably not, but it's going to be more persistent, and you're going to have bouts of deflationary episodes, but because of our debt situation, you're going to need the treasury market to function. Here's the 10-year. Okay, so that's fine, but you can see the SHY, that one continues to rally. But overall, this is the message. The pivot is here, and that is good for asset prices. And until we get further breakdown, besides this kind of recent, call it 3 to 4 week impulse, I see probably more upside. I think this is the impetus for probably still choppy first half, but a more bullish rest of the year. So that's my thought process. It could be wrong. Definitely need to see a few things. Like I said, that move index, get back below 150. You want the VIX to kind of grind lower. You want the dollar to also grind lower. All that would be bullish for markets. But we'll see. We'll see what kind of follow through we get next week. And if those odds of a rate cut over the next few meetings continues. And if it does, that would obviously be good for asset prices. So that's about it. I appreciate you all tuning in to this channel and subscribing to InvestTalk. And a reminder that the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Thank you all, and have a great weekend.